Hey everyone, me Kevin here. In the past few months, I've been very focused on raising cash, and we've talked a lot about this on this channel. Not only did I last week make a video saying I'm going cash, but before that, I've been talking about raising cash through selling options, like selling puts or selling calls. I've also been talking about my interest in RCC, real estate cash crypto, because of the lack of deals in the stock market. Well, now we've got a whole lot of uncertainty. The S&P 500 right now is down 2.2%. We've got a lot of red in the stock market. It was a 90% red day for the S&P 500. And in this video, I'm going to break down exactly why there is so much uncertainty leading stocks and cryptocurrencies to fall, and when this uncertainty will go away, which we expect that when we have uncertainty, stocks and cryptos to fall. When uncertainty goes away, stocks and crypto should go back up. Should. No guarantees. But it's good to know what the underlying uncertainties are and have them all enumerated in a nice, comfortable list, and then align these with dates in terms of when we expect these to go away. So let's get started right now. Right after I thank many of you for joining my amazing programs linked down below on building your wealth. Many of you joined after realizing that I did not win my election for governor in California. And so many of you were like, well, that must mean Kevin's going to have lots more time to hang out with us. And you're probably right. So anyway, thank you to all those of you who hopped in and have been taking advantage of that coupon code that does expire this Friday. But let's get to the list right now. Okay, number one. The Fed this week is not just meeting and having their FOMC meeting, but they're also releasing their new summary of economic projections. The SEP is a big deal because it shows what the Federal Reserve's expectations are for declines in things like the GDP and increases in things like inflation. We expect the Federal Reserve to substantially reduce the GDP forecasts, the gross domestic forecast, product forecast, and to increase inflation forecast, not just for this year, but possibly also going into 2022. I also expect that the Federal Reserve will have a hawkish tone on tapering this year at some point. Probably not in the September meeting. That is probably not going to hear about a taper happening in 2 or 3 days here, but instead, some kind of reiteration that the taper will happen this year, just not now. And obviously the next meeting is November 4th, so that's really when the eyes will be focused on the tapering actually happening. Point is, though, both of these items are going to create uncertainty. Uncertainty over how much the Federal Reserve projections have changed, how weak has the economy really gotten, has the economy really started to decelerate in terms of growth as much as we expect, and is the Fed at the same time of this weakening still going to be focused on tapering, which of course we expect that they will not taper this month because of weak jobs and higher inflation readings. But what are they going to tell us about the outlook for the rest of the year? Is the economy going to be weaker while at the same time we're still going to get a taper? Both of those would be bad news, and that's kind of what we're expecting right now. In fact, so many analyst firms, including Goldman Sachs and Morgan Stanley, have almost all across the board revised down their GDP growth expectations to the point where there are even some estimates that for some quarters of next year, we might be growing at literally zero, an annualized rate of 0 for our GDP, which is crazy. So these are also negative catalysts. These are things that are creating concern in the market. Morgan Stanley says that their base case scenario right now is a 10% correction in the S&P 500, with a bear case scenario of a 20% correction in the S&P 500. We're still not even yet at a 5% correction from highs that we had just a couple weeks ago. We're at like a 4.2% correction. Anyway, though these create lots of uncertainty. China and its regulation has created a lot of uncertainty in the tech space and lately in casinos and the gambling space, or Alibaba specifically, because China has been expressing interest in regulating more. And let me ask you this. What do you think caused the Evergrande crisis in China, where they have over $300 billion of debt that they're defaulting on, and they're the second largest real estate developer in China? Was it either A, too much regulation, or B, too little regulation? Obviously here, too little regulation would lead a property developer to go nuts with debt. I'm not the biggest fan of too much regulation at all, but China's not going to be looking at Evergrande going, we regulated too much, and that's why they failed. China's going to be empowered by this. China is going to be emboldened. China's very likely to go, yeah, y'all effed up, and this is just the catalyst we needed to crack down on everybody else. So, not too optimistic here about Chinese-related stocks, and I'm pricing in bigger discounts for more regulation coming from the Chinese government. This is embarrassment to them. This whole Evergrande contagion. It's a disaster. Now, I do expect it to be mostly contained. I mean, I did a whole video on this. You can check that out. Just type in me, Kevin Evergrande. But I do expect this to be somewhat contained, but the fear of it will still be here. Then, of course, and we've touched on this briefly, but a little bit more detail, growth is decelerating. People are saving more money, but consumer confidence is declining, leading to some lower spending. People like Kathy Wood are suggesting that people already have the things they wanted to buy, like the cars, the TVs, and the iPads, the iPhones and the laptops and stuff. And now we're kind of just waiting to watch if services are going to inflate up, but really that we're seeing a growth deceleration. Note that a growth deceleration doesn't mean you're going to negative growth. It means you're growing, but just at a slower pace. So like if it's all of a sudden it's like, wow, we sold 30% more iPads compared to last year. Well, maybe now it's like, okay, we sold like 2% more iPads, right? That's growth deceleration. It's not shrinkage. Nobody wants shrinkage. But anyway, so we don't really expect revenues at companies to go down, but at the same time as you have growth deceleration, it's also likely that you could have what's known as a margin squeeze or margin compression occur. This is basically when companies become less profitable because the input costs of wages and products go up. So let me simplify that. If you sell an iPhone for $1,500 and it costs you $900 to manufacture it, but now all of a sudden the costs went up to $1,000, but you can only sell the iPhone for $1,525. So in other words, your costs went up by $100 and your sales potential went up by $25. You are losing $75 of gross profit. And that is where margin compression comes in, because we calculate margin by determining, okay, cool, what percentage of your sales were you able to bring in as operating profit, right? And so if your costs go up and the amount that you're selling the product for can't go up as much, you end up with margin compression. So this is actually something that's not very good for corporations either, because ultimately we want cash flow from companies that we invest in. Anyway, let's get to the next issue. This is an interesting one, okay? When the Delta variant started soaring in late July and early August, there was this kind of international move into United States stocks as a flight to safety. That's really because the United States is seen as having, probably being one of the most advanced countries in terms of COVID vaccination, compared to, of course, developing countries, right? It's certainly not as well as like Israel or the United Kingdom, but compared to developing countries, the United States is pretty decent, and we've got a very strong stock market. So that made United States stocks attractive as a potential flight to safety. Now, though, as we're kind of seeing peak Delta, it's possible that people are kind of withdrawing their money from the U.S. stock market, also helping kind of hurt and push down the stock market, which as I've been recording this video, the S&P 500 has kind of continued to go red here. For what it's worth, this is kind of what it looks like. This is your day on the 1 minute chart here on the S&P 500. A little bit of euphoria and then, yep, nope, just kidding. Oh dear, oh dear, oh dear. Anyway, that led me to tweet, which you should follow me on Twitter, led me to tweet that the Black Friday sale is just beginning. But anyway, the next thing is, look, valuations are high, right? Now, there are few great deals in the market right now, in my opinion. That's because of just loftiness and valuation. At the same time, we're seeing kind of a pullback as folks are de-risking, which is exactly why stocks and cryptocurrencies are falling, in my opinion. Now, it is also a concern that we have a debt limit debate coming up, and that it's possible the United States could default on its obligations by mid-October if we do not raise the debt limit by September 30th. This will create a lot of drama in Congress over the next 10 days here. And we also expect drama around the infrastructure package. Will we raise corporate tax rates? Will we raise capital gains tax rates? Will we get that $3.5 trillion infrastructure package passed? Which is basically, and this is the part that gives the market chest palpitations, it's kind of like if you have $3.5 trillion of debt and then you give $3.5 trillion of stimulus checks today, like that would be good. That would prop up the market today, right? Because people would be buying stuff like crazy. But if you all of a sudden say, hey, let's raise taxes today, but then spend $3.5 trillion over 10 years, then that's not as juicy. Not as juicy at all, especially if, again, taxes are going up, while at the same time you're not seeing the benefit of that for quite a while. So when you put all this together, you get this basket or this hodgepodge of real like ugliness and uncertainty, lots of uncertainty. People don't like uncertainty at all. Anytime we have uncertainty, markets fall. I mean, think about the fact that right before the election, the 2020 election, we had a lot of uncertainty and the stock market had like a 6% correction to the downside. When we have uncertainty, stocks fall. It's that simple. Uncertainty, stocks fall. So when will the uncertainty go away? Well, that's what we talk about this right now. I believe that, let's see, interesting. Okay. So, yeah, just reading an update here about the SEC versus Ripple case. That's a whole nother discussion to be had. All right, let's talk about the end to uncertainty. So, number one, the Evergrande debacle and the peak drama of this will likely be over this week. I think we will have a resolution by Friday in terms of how bad it's actually going to be. So, we'll know. That doesn't mean the entire issue is going to be resolved, but I think we'll have more answers by Friday. I also expect that the debt ceiling will be raised, though I do think that's going to take about another 10 days to get to. I think that's going to be a very last-minute event. We'll likely have some kind of stopgap bill or continuing resolution. We do have a vote in the House of Representatives for the bipartisan infrastructure deal scheduled for September 27th, which is next Monday. This could be a good opportunity for us to also raise the debt limit. We'll see. So next Monday has the potential for some optimism, where the Evergrande deal is or debacle has hopefully faded away. The disaster of this debt limit has faded away. But we also have the potential that by next week we'll have new updates again to COVID numbers, or COVID numbers going to continue declining down. That would be very positive for the stock market. By October 13th, we'll have inflation readings again, which I expect to inflect down. I've always been saying that I expect inflation to go down for September and October, which, remember, those reports come out in October and November. So hopefully this is kind of like the pain before the excitement of when inflation starts inflecting down, or I'll just be wrong again. But when you put all this together here, the Fed news this week, which once this week is over, I expect we'll digest the news and then we'll move on. This will be positive for the stock market. The Evergrande debacle over this week, that should be positive for the stock market. Debt ceiling getting raised and the bipartisan infrastructure package, the $1 trillion version getting passed, should be positive. The delay on $3.5 trillion deal, that could actually be positive as well. COVID declining, positive as well. October 13th inflation data I expect to be positive. So when you put all this together, we actually, in my opinion, should not have that long of pain. No guarantees, though. I mean, look at what happened in February. We had like 3 or 4 months of pain, right? But it's worth mentioning that a lot of the pain catalysts we have right now are temporary, and temporary to the tune of really like 1 to 4 weeks max. So just my thoughts right now. I am looking for buy the dip opportunities. I have not bought the dip. I have a lot of cash sitting around, and anytime I buy the dip, I will be sending alerts immediately to all those of you in the Stocks and Psychology of Money group. And folks, thank you. Thank you for watching this video, and we'll see you in the next one. Thanks. Goodbye.